Preparing for PepsiCo Finance Manager interview questions and answers interview, you've reached Candy Mentor and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like and share and drop a topic request in the comments. Question 1. Tell me about yourself and why you want to join PepsiCo as a finance manager. I am a commercially oriented finance professional with experience in forecasting, performance analysis, and partnering with operational leaders. In my current role, I improved forecast accuracy and identified cost actions that protected margin during inflation. PepsiCo appeals to me because finance directly influences pricing, innovation, productivity, and portfolio choices across a global consumer business. I would bring strong analytical discipline, clear communication, and a bias for action, while developing teams and linking financial results to sustainable growth. While answering, connect your finance experience to consumer packaged goods economics, commercial decision-making, leadership, and PepsiCo's scale, portfolio, and Pep Plus agenda. Use a concise career story supported by measurable outcomes. Question 2. Why PepsiCo rather than another consumer goods company? PepsiCo combines the complexity of global beverages with the attractive economics of convenient foods, giving finance leaders a broad commercial scope. Its brands, route-to-market capabilities, and geographic diversification create opportunities to learn across categories while managing different margins and demand patterns. I am also attracted to the company's performance with purpose mindset because growth, productivity, sustainability, and talent development must work together. That combination makes the role strategically meaningful, not simply a reporting position. Make sure to cover PepsiCo's distinctive food and beverage portfolio, global reach, category breadth, iconic brands, performance culture, and Pep Plus commitments. Avoid generic brand admiration. Explain how those factors create meaningful finance challenges. Question 3. How would you build an annual operating plan for a PepsiCo business unit? I would begin with a clean baseline, separating recurring performance from unusual items. Then I would build volume by category, customer, channel, and geography, layering pricing, mix, promotional investment, commodity assumptions, labor, logistics, productivity, and capital spending. I would pressure test the plan with sales, marketing, supply chain, and operations, documenting assumptions and sensitivities. Finally, I would establish monthly scorecards and trigger actions, so the plan becomes a management tool rather than a static budget. In your answer, talk about baseline performance, volume, price, mix, distribution, promotions, input costs, productivity, investment choices, risks, and cross-functional alignment. Distinguish a financially balanced plan from an unsupported target. Question 4. How do you analyze revenue growth at PepsiCo? I decompose revenue into volume, net price, mix, foreign exchange, and portfolio changes such as acquisitions or divestitures. I would also examine gross-to-net deductions, including trade promotions, discounts, returns, and allowances, because shipment growth can mask weaker realized revenue. For example, strong price growth with declining volume may indicate consumer resistance or competitor pressure. I would connect the bridge to category, customer, and pack-level data, then recommend pricing, promotion, or mix actions. Be sure to mention volume, net pricing, product and channel mix, foreign exchange, acquisitions or divestitures, promotional effects, and revenue management. Explain how you separate reported growth from underlying organic performance. Question 5. How would you evaluate a proposed price increase for a PepsiCo product? I would estimate the price increase's incremental gross profit after considering elasticity, competitor actions, promotional funding, mix, and potential distribution losses. I would analyze consumers by segment and pack because a small single-serve increase may behave differently from a family pack change. I would model base upside and downside cases, align with sales and marketing, and test the change where practical. After launch, I would track volume, net revenue, market share, and contribution margin weekly. Focus on elasticity, competitive pricing, pack architecture, consumer affordability, retailer response, promotional funding, volume risk, contribution margin, and scenario analysis. Explain how you would monitor results after implementation. Question 6. What is the difference between gross margin and contribution margin, and why does it matter at PepsiCo? Gross margin is revenue less cost of goods sold, while contribution margin typically deducts additional variable costs required to serve a product, customer, or channel. At PepsiCo, that distinction matters because trade spending, freight, distribution, and promotional costs can materially change economics after production. A product may show an attractive gross margin but weak contribution after customer-specific investments. I would use consistent definitions, compare incremental profit rather than percentages alone, and protect long-term brand health when evaluating actions. In your answer, define both measures and explain the treatment of manufacturing costs, trade spending, freight, and other variable costs. Show how contribution margin supports pricing, promotion, channel, and portfolio decisions. Question 7. How would you manage forecasting during significant commodity inflation? I would quantify exposure by commodity, packaging material, currency, and contract period, then distinguish locked costs from future risks. Next, I would model recovery through pricing, mix, productivity, sourcing, and waste reduction, while testing volume elasticity and competitor behavior. I would present a base case plus downside and upside scenarios, clearly identifying decision triggers. Forecasts should update frequently as market data changes, with owners assigned to each mitigation action and variance explained against the last approved view. Make sure to cover commodity exposure, timing, hedging assumptions, pricing recovery, productivity, mix, scenario ranges, and cadence. Emphasize transparent assumptions and actions rather than simply revising the forecast downward. Question 8. Describe how you would explain a material unfavorable forecast variance to senior leadership. I would start with the headline impact and quantify the bridge from plan, separating volume, price, mix, costs, foreign exchange, timing, and one-time items. Then I would identify the operational root cause, distinguish controllable from external factors, and explain whether the issue is temporary or structural. I would finish with actions, owners, timing, and the revised outlook. Senior leaders need clarity and choices, so I would escalate early rather than wait for perfect information. Focus on a concise bridge from plan to actual, root cause separation, materiality, controllability, timing, corrective actions, and forecast implications. Show that you communicate the message without hiding bad news. Question 9. How do you partner with sales when finance challenges a promotional plan? I would begin by understanding the commercial objective, customer commitment, and strategic role of the promotion. Then I would evaluate incremental volume, realized price, trade spending, cannibalization, operational costs, and expected contribution versus a no-promotion baseline. If the economics are weak, I would offer alternatives such as a different pack, timing, customer, or funding structure, instead of simply rejecting the proposal. Afterward, I would review actual results with sales and improve future assumptions collaboratively. Be sure to mention shared objectives, customer economics, incremental volume, cannibalization, trade spend, post-event analysis, and respectful challenge. Position finance as a decision partner rather than a gatekeeper. Question 10. What financial controls are most important in a PepsiCo finance organization? The highest risk areas deserve disciplined controls: revenue recognition, customer deductions, trade spend accruals, inventory, manual journals, account reconciliations, and system access. I would ensure appropriate segregation of duties, evidence-based review, documented estimates, and timely exception resolution. Strong controls should be embedded in the monthly close rather than treated as an audit exercise. I would also monitor recurring issues, investigate root causes, and automate preventive checks where possible, improving both compliance and reporting efficiency. In your answer, cover segregation of duties, journal entries, account reconciliations, revenue recognition, trade spend accruals, master data, access controls, close governance, documentation, and remediation of control deficiencies. Question 11. Walk me through your approach to month-end close. I would establish a close calendar with clear owners, dependencies, materiality thresholds, and escalation points. Before close, I would review recurring accruals, open purchase orders, customer deductions, inventory movements, intercompany balances, and unusual transactions. During close, I would prioritize high-risk entries and reconciliations, then perform analytical review against actuals, forecast, and prior year. I would communicate preliminary results early, resolve exceptions quickly, and finish with documented lessons that make the next close faster. Mention a close calendar, ownership, materiality, accruals, reconciliations, variance analysis, intercompany items, review controls, and communication. Demonstrate speed without sacrificing accuracy or management insight. Question 12. How would you improve working capital in a beverage and snack business? I would analyze cash conversion by market, customer, product, and process, then identify the largest structural opportunities. Receivables actions might include dispute resolution, deduction discipline, and term governance. Inventory improvements could involve better demand sensing, production sequencing, safety stock policies, and obsolete stock controls. On payables, I would review terms and supplier processes without harming relationships. I would track days sales outstanding, inventory days, payable days, and service levels together because cash gains cannot justify lost sales. Focus on receivables, inventory, payables, production planning, demand variability, customer terms, obsolete stock, supplier relationships, and service levels. Explain that working capital improvement must not damage availability or strategic partnerships. Question 13. How would you evaluate a capital investment in a new production line? I would compare the investment with the capacity constraint it addresses and the cost of alternatives, including third-party manufacturing or overtime. The model would include incremental volume, pricing, contribution margin, labor and logistics savings, capital spending, maintenance, working capital, taxes, and terminal value. I would evaluate NPV, payback, and utilization under several demand scenarios. Beyond returns, I would assess flexibility, execution risk, quality, sustainability, and whether the project supports the long-term network strategy. Be sure to discuss incremental volume, capacity utilization, capital cost, labor savings, maintenance, working capital, depreciation, taxes, NPV, payback risks, and strategic flexibility. Question 14. Tell me about a time you influenced a decision without direct authority. In one role, sales planned a promotion that appeared attractive on revenue but diluted contribution after trade spending and cannibalization. I built a customer-level analysis, validated assumptions with the account team, and presented two alternatives that preserved the commercial objective with better economics. Because I acknowledged the team's volume target rather than dismissing it, the discussion stayed constructive. We selected the revised offer, improved contribution by approximately $400,000, and created a post-event review process for future campaigns. In your answer, use a specific situation, quantify the business impact, explain stakeholder concerns, describe your evidence and communication, and show how you secured commitment without relying on hierarchy. Question 15. Describe a time you made a difficult recommendation with incomplete data. During a supply disruption, we had incomplete information about recovery timing but needed to allocate limited inventory across customers. I gathered the best available demand, margin, contractual, and strategic account data, then built scenarios based on different recovery dates. I recommended prioritizing products and customers with the highest service and contribution impact while preserving critical commitments. We reviewed the decision daily as facts changed. The approach limited revenue loss and gave leadership a transparent framework for adjusting allocations. Make sure to explain the decision context, information gaps, material assumptions, downside protection, stakeholder consultation, recommendation, and outcome. Demonstrate judgment and speed while acknowledging uncertainty. Question 16. How do you lead and develop a finance team? I set clear priorities, define what good looks like, and connect each person's work to business outcomes. I delegate meaningful ownership rather than only tasks, then use regular one-to-ones to coach judgment, communication, and technical skills. I provide timely feedback, recognize strong performance, and address gaps directly with practical development plans. I also rotate team members through commercial and operational discussions, building broader capability and succession depth while creating an environment where concerns can be raised early. Focus on clear expectations, coaching, delegation, technical development, business exposure, feedback, succession planning, inclusion, and accountability. Include how you balance high standards with psychological safety. Question 17. What would you do if a business partner asked you to delay recognizing an expense? I would first understand the transaction and ask for the business rationale, but I would not delay recognition merely to improve reported performance. I would assess the accounting guidance, supporting evidence, timing, materiality, and whether the cost relates to current period activity. I would explain the implications respectfully, document the conclusion, and involve controllership or internal audit when appropriate. My responsibility is accurate reporting and trusted partnership. Protecting a short-term metric could create greater compliance and credibility risk. Be sure to mention accounting principles, materiality, evidence, professional skepticism, escalation, documentation, and maintaining the relationship. Make clear that performance pressure never overrides accurate reporting. Question 18. How would you assess the financial impact of a product innovation or reformulation? I would evaluate the innovation from both consumer and economic perspectives. The model would estimate incremental volume, cannibalization, net pricing, ingredient and packaging costs, manufacturing complexity, marketing investment, distribution, working capital, and potential price elasticity. I would test launch timing, adoption, and retailer acceptance under multiple scenarios. Success would not mean revenue alone. I would monitor incremental contribution, household penetration, repeat rates, market share, and whether the innovation strengthens the portfolio over time. Discuss consumer demand, cannibalization, incremental volume, price, margin, ingredient and packaging costs, capacity, marketing support, distribution, regulatory factors, and post-launch measurement. Question 19. What metrics would you include in a monthly PepsiCo performance dashboard? I would design the dashboard around decisions, not just data. Core measures would include net revenue growth, volume, price and mix, market share, gross margin, contribution margin, trade spending, productivity, forecast accuracy, inventory, receivables, cash conversion, and customer service. I would show actual versus plan, prior year, and latest estimate with a concise bridge explaining movements. Where relevant, I would include waste, packaging, energy, and other PEP Plus metrics, linking financial performance with operational and sustainability progress. In your answer, include net revenue, volume, price/mix, gross and contribution margin, trade spend, market share, forecast accuracy, productivity, cash conversion, service levels, and sustainability-relevant measures. Question 20. What would your priorities be during your first 90 days as PepsiCo Finance Manager? My first month would focus on listening, understanding the portfolio, reviewing performance drivers, mapping stakeholders, and learning the close forecast, control, and planning processes. In the second month, I would validate pain points through data and team discussions, identifying quick wins without disrupting critical routines. By day 90, I would present a prioritized roadmap covering forecast quality, commercial insight, productivity, controls, and team development. I would build credibility by delivering a few measurable improvements while aligning longer-term priorities. Focus on listening, stakeholder mapping, business and category understanding, close and forecast quality, control assessment, team capability, quick wins, and a prioritized improvement roadmap. Show humility before changing processes. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.